You ever noticed how whenever the economy gets a little shaky, governments have this almost magical solution? They call it injecting liquidity. It sounds super fancy, right? But it's basically a polite way of saying they're creating money. The real question is, what does that actually mean? And more importantly, where does all that new cash go?
Yeah, you heard that right. They just create it. Trillions of dollars appearing out of thin air with the push of a button. And the story we're always told is that this is for us, for the people, to keep the economy from grinding to a halt.
And that right there is the million-dollar question. Or, I guess, the trillion-dollar question. When all this new money floods the system, who's at the front of the line? Does it just show up in your bank account? Spoiler alert, it does not.
Let's just be brutally honest here. If you're working a 9-to-5 job, you are not the one benefiting from this. In fact, you're the one who pays the price. You're the victim of a 300-year-old glitch that's been hiding in plain sight.
So what is this glitch? Well, to really get it, we have to jump into a time machine and go all the way back to the 18th century. We're going to meet this guy, an Irish-French banker named Richard Cantillon. He was the one who first cracked the code on how this whole game is played.
Cantillon noticed something that was both super simple and absolutely genius. He asked, when the king prints a bunch of new gold coins, who gets to spend them first? Well, the king, obviously, and his friends. They get to go out and buy stuff while all the prices are still low, before anyone else even knows the new money exists. And that simple observation, that's what we now call the Cantillon Effect.
Okay, so fast forward to today. The king isn't a guy in a castle anymore, it's the central bank. And the flow is just as simple. Step 1, the brand new money goes straight to the big banks. Step 2, the banks loan it out at super low interest rates to their biggest clients, the billionaires and hedge funds, who immediately buy up assets like stocks and real estate at yesterday's prices. And that leaves step 3. Well, that's you.
By the time any of that money trickles its way down to you, maybe in the form of a measly little 3% raise, the game is already over. The cost of everything, your groceries, your gas, your rent, has already shot through the roof. That raise you got doesn't even come close to covering the new cost of living. You're basically getting the leftovers.
And this brings us right to the heart of the problem for anyone earning a salary today. This 300-year-old idea explains why so many of us feel like we're stuck on a treadmill, running harder and harder every year just to stay in the exact same spot.
Just look at this. On one side, you have salaries just kind of plodding along, barely moving. On the other side, you have the prices of assets, stocks, real estate, just going completely vertical. This is the trap. You're trading your time, your most valuable resource, for a currency that is literally designed to become weaker over time.
And let's be really clear here. This is not an accident. It's not a bug in the system. It is the system's primary feature. It is a giant continuous transfer of wealth from people who work for their money to people who simply own the things that money is supposed to buy.
Here's another way to think about it that's kind of terrifying. Your 9-to-5 job isn't just a job, it's effectively a bet against the US dollar. A short position means you're betting something will go down in value. So every day you go to work, you're betting your entire financial life on a currency that is actively being devalued by the very people who print it.
Look, this isn't just some abstract theory from a textbook. This is real. This is that feeling you get at the checkout line. It's the silent anxiety you feel when you look at your bank account. It's the reason you feel like you're constantly falling behind, no matter how hard you work.
Let me just paint a quick picture for you. Let's say it's the 1970s. You walk into a grocery store with a $20 bill. You're walking out of there with a shopping cart that is literally overflowing with food for the week.
Now, let's try that today. You walk in with that same 20 bucks, what do you walk out with? Maybe a fancy loaf of sourdough and a single kind of sad-looking lime. That difference? That is the value of your money evaporating right in front of you.
And that's exactly what the Cantillon Effect is. It's a tax, but it's an invisible tax that nobody ever gets to vote on. There's no debate, no announcement. It's just the quiet, constant sound of your savings and the value of your paycheck just disappearing.
And if you want to know why buying a house feels impossible, well, here it is. All that new, cheap money floods the housing market first. Big investment firms get those low-interest loans and start buying up entire neighborhoods, pushing prices up long before that money ever finds its way to your paycheck. So, okay, we've gone through the history, the mechanics, and the gut-wrenching real-world impact of all this. What's the final verdict? What's the takeaway from living in a system that feels like a casino?
I think this pretty much says it all. The house always wins. And yeah, it's a whole lot easier for the house to win when it also owns the machine that prints the money. That is the fundamental, inescapable truth of the system we're all playing in.
And all of this leaves us with one last absolutely crucial question that you have to ask yourself. If your job is a bet against the dollar, what's your bet for? In this game, what's your long position? What's your strategy to do more than just survive? What's your strategy to actually win?